Did you know that Nvidia, the tech giant revolutionizing AI in gaming, has raised to a jaw-dropping $3.6 trillion valuation? With growth expectations exceeding 30% annually, the stakes couldn't be higher. Can they maintain their dominance, or is the market being too optimistic about their future? Nvidia managed to achieve spectacular growth over the last few years while also greatly expanding their profitability margins. This justified a big increase in stock price. The question now is if the rise was too optimistic. To answer this, we will first analyze what growth is required for the next 8 years to justify the $3.6 trillion valuation, to then look at Nvidia's different business segments and answer if the required growth rate seems achievable. With the current profitability and cost structure of NVDA, the company needs to achieve revenue growth rates of 31% per year for the next 8 years to justify the current price. This means that the company also has maintained margins and free cash flow conversion at current levels. We'll now examine the implications for the various segments and how feasible this appears to be for the company. For the data center segment, experts expect a market growth rate of 31.6% per year for the next years. For context, Nvidia achieved a quarter-over-quarter growth rate of 17% and a 112% year-over-year growth rate in their latest quarter. For their gaming segment, research firms predict growth rates to be between 29% and 42% per year. This would give us an average market growth rate in this segment of 35% per annum. Here, Nvidia achieved a growth rate of 15% year-over-year in Q3 of 2025. For the other segments, visualization and automotive, we can assume 31% and 15% revenue market growth per year. With these growth rates, we get 31.7% as the expected growth rate for Nvidia's business. Assuming the profitability and other metrics stay similar, the company is even slightly undervalued by 4% when we assume this growth rate, giving us a fair value share price of $150. However, despite Nvidia's dominant position in AI and in GPUs, investing in the company poses risks. The company's market share may be eroded by fierce rivalry from rivals like Advanced Micro Devices and Intel, or more important, from new technologies like quantum computing, for example. Furthermore, because the semiconductor business is cyclical, Nvidia is subject to changes in demand, which might result in overstock or pressure on prices. Because of its reliance on significant businesses like artificial intelligence, it is susceptible to downturns in the economy or declines in consumer spending, as only 5 customers current make up around 50% of Nvidia's revenue. I guess they could be Amazon, Meta, Microsoft, and Tesla. Once their growth slows down, Nvidia will follow soon. Revenues might be impacted by geopolitical conflicts that restrict access to significant markets, including trade restrictions between the United States and China. Additionally, since the market is expecting growth rates greater than 31% PA, the company is vulnerable to steep corrections if growth slows or expectations aren't fulfilled. With all this in mind, is the company still a compelling buy right now? With the optimistic yet realistic assumptions we took, the company seems to currently be trading at the fair value range. This market cap, therefore, is justified. If the company manages to grow at the market rates of the segments it is operating in, which is a top-line growth rate of 31.7%. Considering the very high quality, exceptional market position in the AI space and Nvidia's track record in growth and profitability expansion, especially in the past 2 years, the company could still be a compelling buy even after the recent run-up, especially when considering that through our DCF analysis, higher growth rates in the early years result in a higher valuation, as the cash flows aren't discounted over that many years. This seems likely when we compare Nvidia's growth rates over the last 2 years to the expected market rates. That's why I currently rate the company a buy, and I am monthly adding to the position in small installments. What's your perspective? Let's discuss in the comments below.